So that's my goal. And as you'll see in webinars to come and what I'm going to be sharing with you today, I really want to give attention to detail and teach you something so that you can go away with it and use as early as tomorrow or Monday, I should say. All right, so here's what you're going to learn today. I'm going to give you two great edges. The first one is designed to get you on the right side of the market. And so many times traders lose money because they're virtually on the wrong side. So we're going to show you a simple tool that will get you on the right side of the market 90% of the time. And then edge number two is once you know what side of the market to be on, we're going to show you how to fine-tune your entries. Many times you'll lose in a trade or an investment, not because you were wrong about the stock going up or going down if you wanted to short it. It was just your entry that was misplaced. So we're going to show you how to fine-tune that entry. And then we're going to put these two edges together and show you how they make up one of our most consistent strategies, and I'll give you the rules to this strategy. This is our proprietary trading strategy, usually reserved for the members of Specialist Trading, but I'm going to share the rules with you today. Okay, so lots of things we're going to teach you. So remember, if you have any questions, just write them down. I won't be taking any questions for the last 10 or 15 minutes of the presentation. All right, so why don't we begin, okay? Let's start out with an example here. Has this ever happened to you? Okay, let's say you see a stock, and we've purposely taken out the name of the stock and the price just to show you for educational purposes. But you see a stock has been coming down. Doesn't matter what the time frame, if this is monthly, weekly, or even intraday. And it's time to buy because you feel it's starting to bounce up and you think it's hit a bottom. So you jump in and you buy, and the minute you get in, what happens? It goes the exact opposite direction, right? Or it can happen the other way. Let's say you're following a stock and it's gone up too high. Let's say some news service or chat room you're in says it's meeting some resistance, so it's time to short. So you think that it's rolling over, so you want to short it before it really starts to fall out of bed. So you sell, and look what happens. Does this look familiar? Remember, this is probably the way I used to trade when I first started trading on the floor. Well, what if there were a tool that could give us a high percentage rate of being on the right side? Because obviously in these two examples, we were on the wrong side of the market. All right? Well, there is at Specialist Trading. This is probably our most important tool that we have for our members, and this is our first edge. This is the buy-sell line. As I stated, the most important tool we have because it's virtually used in every methodology, every strategy that we employ at Specialist Trading. It's extremely powerful, but at the same time, it's extremely simple. I'm going to share with you today just exactly what it is. It's the 50-period simple moving average. That's all it is. But what I want you to do is, on any stock that you happen to be in or any market you're in currently, plot a 50-period simple moving average. It doesn't matter if it's a 5-minute chart or a monthly chart. It doesn't matter what time frame. Just simply plot a 50-period simple moving average. And then once you've plotted that, you have to ask yourself a question, because this is how you use the buy-sell line properly. But you have to ask yourself this question before you pull the trigger, before you buy or sell. And that is, where is price in relation to that buy-sell line or the 50-period simple moving average? Okay, I'm going to state that again. This is how important this is. Plot a 50-period simple moving average, and before your strategy, before say it gives you a buy or sell signal, before you pull the trigger, ask yourself, where is price in relation to that 50-period simple moving average or the buy-sell line? And you'll only come up with two possible scenarios, because if price is above, if price has been consistently above the 50-period simple moving average, you're only going to be looking for buy scenarios or buy signals. You'll only take buy signals. And if price is below, then you'll only look to sell, or you'll only be taking sell signals. That's how simple it is, but let me show you how powerful. Now remember that scenario we had before? We firstly wanted to buy because we thought we had bottomed out, but then it rolled over. Well, if we simply added the buy-sell line, we would have asked ourselves, where is price in relation to that? Obviously, price is below. So if price is below, we have no business even considering buying. We should only be looking for sell opportunities. So we would have saved ourselves some money here. How about this scenario? Originally, we wanted to sell because it looked like the stock was topping out. But then, lo and behold, it was like it was waiting for us to get in short, and then it started to go back up. Well, if we had simply plotted the buy-sell line, and we'd ask ourselves, before we took that sell signal, we'd ask ourselves, where is price in relation to that buy-sell line? Obviously, price is above. And if price is above, we're not even going to consider going short. We're only going to consider looking for buy scenarios. We would have saved ourselves a lot of money by staying out of this trade. Okay? See how simple it is, but how powerful. Now, a lot of people would say, well, Steve, I've seen this before. Some traders like to talk about a 200-day moving average. Others talk about a 20-period moving average. How important really is this? How important is the buy-sell line? This is nothing new, and plus it's extremely simple. That's true. Remember, my mentors taught me that it's the simple things that work. Well, the way we measure the importance of any tool or methodology that we have at specialist trading is how well it transfers over into different time frames and into different markets. So let's go back to a different time frame. Let's go back to 2008. You remember that was the beginning of a really big downturn in the markets. It was the beginning of the recession, and a lot of people who had been making tons of money all of a sudden were getting killed in the markets, and most of them lost everything. In fact, some stocks went down to zero, or they lost about 75% of their value. Could the buy-sell line have helped us, or at least given us some type of early warning to get out of the market? Well, let's look at a chart of the S&P index. This is a weekly chart going back to end of 2007, beginning of 2008. As we see here, in January of 2008, before anything happened, we had major red flags here that price was below the buy-sell line on a weekly basis. Now, what we look for are 2 or 3 consecutive closes below or above the buy-sell line to tell us what side to be on. So right here in January, we had 2 consecutive closes before. So at this point, had you known this, if you were an investor and you were long the market, you could have either moved your stops to unchanged, or maybe just at least locked in some profit. Or you could have exited a portion of your position and captured some gains, or maybe you would have exited the market altogether. And then if you were a more aggressive trader, you would have said, well, since on a weekly time basis we're below the 50 period or the buy-sell line, I'm going to start to look for some shorting opportunities. And you would have done extremely well the way most of our clients did during 2008, 2009. Okay? Now, what about when the market finally turned around? Well, let's go to a different time frame. Let's go to a daily bar time frame of the S&P index. And in March of 2009, we had consecutive closes above the buy-sell line, telling us that the market most likely finished going down and is starting to look like it's going to turn into an uptrend now. So now if you were short, it's time to look for ways to cover, maybe to lock in some profit. And if you were on the sidelines sticking out the entire debacle in 2008, you could have said, well, maybe it's time to get back in the market. And you would have saved all that money not being invested. Okay? Now, this is just examples here of showing, daily and weekly bars. What if you were saying, like, well, Steve, this is all well and good, but I like to day trade. I'm not an investor. I'm not a swing trader. I look at 5 and 10-minute charts. How could that help me? Okay, well, do you remember back in 2010, that little thing called the flash crash? There were a lot of traders that said, Steve, I don't know how. I know you teach students how to deal with the markets, but I don't know how anyone could have profited during that flash crash that day when the market went down over 1,000 points. Because basically, the little guy like me who has a $10,000 or $15,000 account can't survive because it's the big boys who are in charge or all the mechanized programs. Okay? And I said, not really, because if we look at a 5-minute chart of the S&P index, on the day of the flash crash in May 2010, we ask ourselves, for the majority of the day, where was price in relation to that buy-sell line, the 50-period simple moving average? Price was below the entire day. So this means even as an intraday trader, you had no business thinking about going long. The only way you would have lost money that day would have been if you were trying to pick a bottom. And there's no way we would have tried to buy because price was below the buy-sell line. So if you follow this simple rule you see on a weekly, a daily, or even an intraday time basis, you see it really heightens your percentage to be successful, to give you that consistency in your trading. Just this simple rule of plotting a 50-period simple moving average and then asking yourselves, where is price in relation to that? So on the flash crash, some of our members had the best days ever shorting the market with a number of our strategies and techniques because you were in sync with the market. You were simply just going in the direction that it wanted to go. Now, this works in some current stocks. We look back here in 2009, in April 2009, a lot of people missed the boat in Apple. Well, we see here in April of 2009, we had consecutive closes above the buy-sell line. So Apple was trading about 120. Could have, if you're an investor, bought a long-term stock on a weekly time frame. And Apple has pretty much been above its 50-period simple moving average for a long time. But if we look at a current chart, coming into last year and then this year, we were above the 50 period, but look what happened in December of 2012, last year. We had consecutive closes below the buy-sell line. So roughly 100 points ago, if you were an investor in Apple, you would have gotten out. I know there are a lot of people that were left holding the bag and right now are suffering because of their Apple investment. Well, our members knew that in December of this year, they probably would have exited or tightened their stop so that they would have exited once it went any lower. And you would have, at least missed a nice 100 point to the downside, as Apple has done in the last 2 or 3 months. Now, a lot of traders like to trade ETFs. So people say, well, Steve, this works great in stocks or futures. How about ETFs? Well, here's the ETF Gold, which monitors gold price. A lot of people have been watching gold lately, wondering when it's going to bounce. Well, all we do is tell our clients, listen, since November, we've been well below the buy-sell line, so all our members have only been looking for shorts. We haven't even considered going long gold yet. Until we see that this ETF goes above its 50-period simple moving average, we will continue to look for shorting opportunities in GLD. So this was a very current chart up until yesterday. Okay, so now we know how to be on the right side. We have a technique that has a real high probability of getting this on the right side. Once we know that we're on the right side, we want to fine-tune our entry because this doesn't guarantee that we're going to make money still. We have, many times we're on the right side, but we just enter at the wrong time or at the wrong place. So how can we fine-tune the entry so that it'll give us an even higher percentage rate of getting in the trade and getting a really nice entry point? Well, we can do that. But first of all, let's look at the reasons why most traders will enter a trade. And this is pretty common. We kind of surveyed a lot of the people, and plus a lot of traders I personally know. We asked them how we exactly know how to know when to enter and when we can do this. But first of all, before I go any further, can I just make sure that we have a quick sound check? Can we just make sure that everyone is hearing me okay? I just got a note here that possibly it wasn't coming through loud and clear. So if you can just answer in your question box whether you're hearing me okay, and then I'll continue going on with the reasons why most people will enter into a trade. Okay, looks like we're coming through loud and clear. Thank you so much. I just wanted to make sure. I got just a quick note that possibly some of you weren't hearing me well. So why don't we begin? And once again, for those of you who may have entered late, remember we're going to have a question and answer portion at the very end of today's webinar. This webinar is being recorded, so I'll give you the email address of where you can email us if you'd like to get a recording of this, just to study some of the information I've given you, as well as ask any questions. But please keep them to the very end. Okay, so these are the reasons why we as traders, like to enter a trade. First of all, the price is too low, right? I mean, how many times have you heard, Steve, this stock is way too oversold. You got to buy it now. It's never been this low before. Or the exact opposite. Oh, this stock is way too overbought. Okay, it's hitting resistance. There's no way it can get through it. You've got to short it. So that's my reason to enter short. Or a lot of traders like to subscribe to some trading guru or some trading room. I mirror whatever he does. In other words, if he buys, I buy. If he sells, I sell. Those are my reasons why I enter a trade. Or there are a lot of technicians. A lot of people here just solely look at indicators. Maybe they have 10, 20 indicators on their screen, and when everything is lined up, that's when you get in, or that's when you get out. Lastly, probably the most popular reason for entering a trade is fundamental news. A lot of traders will not do anything until they wait for the earnings to come out, or until they wait for the employment figures to come out, or there was some number that came out today. Can't do anything until that number comes out. So these are all the major reasons why most traders will enter into a trade. But if you see one thing here, there's one common denominator among all these things, is that they're all outside sources. In other words, they're all things outside of what we should be paying the most attention to. So in order to clarify that, what do we need? We need a clear-cut plan for entry that's based on what the market you're trading is telling you, and not what an outside source is telling you. In other words, this is one of the most important things that was ever taught to me as a trader on the floor by my mentors. They said, Steve, you're putting far too much importance in indicators lined up on your screen here, or far too much importance on waiting for the earnings to come out. Learn to listen to what the market is telling you instead of what these outside sources are, because that's going to give you the best information. It's probably going to give it to you before these outside sources. So remember, You need a plan that's based on what the market is telling you and not what an outside source is telling you. All right, so this brings us to our second edge. This is the confirmation method, the second most important method we use at specialist trading along with the buy-sell line. So what exactly is it? Well, confirmation is the verification that the trend has resumed in the desired direction. So this is your signal to enter the trade. A specialist always, I repeat, always waits for his trade to be confirmed before entry. All right, now someone could see this, say, well, what does that mean? Okay, I want the trend to resume. What does that mean? Here's the easiest way I know how to express this. It's the same way it was taught to me. Imagine you're at a train station and you want to go from point A to point B. And you're waiting at the queue. You're outside waiting for the train to come. And you see a train coming down the tracks, but it's going and heading in the opposite direction of where you want to go. Would you jump on that train? Most likely not, because it's heading in the wrong direction, right? You want to wait for the train that's going in your direction and jump on that one because it's confirming that it's going in your trend direction. It's the same way with trading. We want to have some type of confirmation that the stock has resumed going in our desired direction. So in other words, if we're going long, we want to see that it's going in our direction, upwards. If we're going short, we want to see that it's confirmed that it's going lower. So how exactly are we going to confirm, though, that it's headed in our direction? Do we just simply wait for it to go that way? We need a little bit more structure. Well, here it is. These are the rules for the confirmation method. Now, one thing I want to explain to you, you can write these down, but please remember, this is where most students of mine have difficulty. They think that this is a strategy. This is not a strategy. This is just a technique for entry. Okay? You add this onto your strategy. So the strategy has to give you a buy or a sell signal, and once it does, then you apply this confirmation method. Okay? So let's say your strategy, and it doesn't matter whatever your strategy is. It could be based on fundamental news. It could be based on the full moon. It doesn't really matter. But if it gives you a buy signal, instead of buying at the market, or instead of placing a limit lower, what you want to do is you only want to buy once price trades one tick above the previous bar's high. Okay? So if it gives you a buy signal today, you want to buy on Monday if it trades one tick above today's high. That's it. Now let's say your signal gives you a short signal, regardless of what it's based off of. Instead of selling at the market, instead of placing a limit in to go short, you're only going to sell once price trades one tick below the previous bar's low. All right? That's the confirmation method. We need to see that it's traded either one tick above or one tick below the previous bar. And as long as our strategy is still telling us it's okay to go long or to go short, you're just going to continue to watch the bars and scale down or scale up until you enter into the trade. Let me give you some examples so you can understand here. All right, remember we had this example before. We originally wanted to buy because we thought we had bottomed out, and it looks like some trading room we're in told us you have to buy here. It's too low. It's too oversold. But instead of listening to an outside source, we learned to listen to the market, and we plot our buy-sell line, and the buy-sell line says we shouldn't be buying at all. All right, so say you regroup and you go, you know what? One of the strategies I look at actually says that this is a sell signal. So normally what most people would do is sell at the market or place a limit in there. We're not going to do that. We're going to apply our confirmation technique, and this means that we're going to track from when the signal was given to us, and we're going to go short only if we trade where these red horizontal lines are, if we trade one tick below. All right, so far we've tracked it. We haven't traded, so we're not even in the trade yet, but our strategy is still telling us to go short. So we just continue to track until one day, ultimately, we trade below the previous bar's low, which was right here. And that's where you enter. Remember, we want to get on that train that's headed in our direction, and this is the confirmation that the train is headed in our direction, and look what happened. See how simple that is? Now, someone would say, and this is where my students always say, they say, well, Steve, if I just had shorted right here, I would have gotten the same price, if not better, than waiting 2 or 3 days. Well, that's true. But the confirmation technique is not designed to get us in at the best price. We're not designed to short at the very high, and it's not designed to get you in long at the very low. What it's designed to do is just to confirm that once you enter, most likely the odds are in your favor that it will continue going in that direction. Because we know as traders, we hate to enter into a position and see it go the opposite direction. It's the worst feeling in the world, right? You hate to buy something, buy a stock, and then the very next day it goes the opposite direction. It's very disheartening, it's very discouraging, and you start to doubt your strategy. We want to put the odds in our favor for getting into a trade, and the minute we get in, it continues to go. So once again, we're not concerned with buying at the very low and selling at the very high. We're concerned with entering and then seeing price most likely head in our direction. How about the other example? Remember, we originally wanted to go short. Let's say some chat room we were in said the stock is way too high, it's hitting resistance, but we know that after we added the buy-sell line, that there's no way anyone should short this. So now you kind of look at it again, and maybe one of your strategies or a new strategy you happen to purchase says this is actually a buy signal. So rather than simply buying at the market, you apply the confirmation technique. And so you wait to see, once the buy signal was issued, as long as it's still in effect, as long as your strategy is still saying it's okay to go long, continue to monitor and track down until one day we will trade at or above the previous bar's high, which we did right here the very next day. So this is the day you would have entered. This was your confirmation that we're probably most likely going to resume the trend upwards. And then look what happened. Okay? Once again, we did not get in at the very lows, but we're not designed. We want to get in when the trend is going to go in our direction. That's all we're looking for. So let's look at some more confirmation examples. Remember, these are for educational purposes, just so that you understand the process. But please remember that confirmation, as I stated, is not, I repeat, it is not a strategy. It is simply a piece of the puzzle of a strategy. So you can apply this confirmation to whatever current strategy you're trading, whether it's one of mine or someone else's, and you can just say, well, whenever I get a buy or sell signal, instead of what my strategy used to say buy or sell at the market, I'm going to apply this confirmation technique, and you'll see how it'll really fine-tune your entries. All right, so here's a chart in WIN going back to the end of the year, just a couple of months ago. Now, most traders, they would see this as some type of resistance, and once we traded above, they say, well, that's a buy signal. We broke out, and we should go long, right? Rather than simply buy here the way most traders would have, had you bought there, look what would have happened. It would have gone straight down, and most likely you would have been stopped out. Now, it really wasn't a bad buy, because if you look later on in the month, WIN was much higher. It was just you had to fine-tune your entry. So that's what the confirmation method does. Rather than just simply buy at the market or place a limit somewhere here, we would wait for price to trade one tick above the previous bar's high. And as long as we still have a buy signal in effect, we will not buy until it trades above. And on this day, it did. I believe this was the last day or the second last day of December of last year. And we would have entered roughly about 112. And then look what happened. In the next month, stock was up to like 126 roughly. Okay? How about the short side? Well, we ask ourselves, where is price in relation to the buy-sell line in the IBM? And obviously price is below, so we're not going to look to bottom fish to try and buy IBM. We're only going to look to short. So when IBM was falling out of bed here in the beginning of November, most people would have said, well, I'm going to jump on in and sell. But we would wait, use our confirmation method, and once price traded one tick below the previous bar's low, that's where you'd enter. And then look what happened. This is a confirmation. Many times you may have to sit 1 or 2 days where it doesn't go in your favor, but that's okay. That's much better than sitting a whole week or two, as you saw with WIN, where you would have had to wait for a week or two before it went in your direction. How about Apple? Let's say you want to trade intraday. Let's say you're saying, well, Steve, I don't trade daily or weekly bars. I trade intraday. Well, here's Apple. This was going back to a couple of weeks ago. This was on the 6th of February. And we see here that we're above the buy-sell line, so we're looking for a buy opportunity. Now, right here, someone might say, well, we just broke out, so I'm going to buy. Well, rather than do that, if you have a buy signal, apply the confirmation technique. And once price traded above on this 10-minute bar, you would have entered and got a much better price around 455, and in about 30 minutes you would have made roughly about 10 points in Apple. All because you're using the two edges we shared with you, the buy-sell line and the confirmation technique. Going even to a smaller time frame in DVN on a 5-minute chart, safe to say we should only go short because we're below the 50-period simple moving average. And here's some nice confirmation examples where you could have gone short and then seen the trend resume in your favor, and then wait for price once again, getting some type of signal to go short, and then use the confirmation method. So you see this in any direction, in any time frame, and in any market. So one of the other advantages of using the confirmation method is that it not only gets us in at the beginning of a trend, but it also keeps us out of bad trades as well. Remember, sometimes the best trades we have are the ones we never take. Now here's an older chart of Amazon. It's a couple of years old, but I use this for educational purposes to show you how oftentimes it will save you from losing a lot of money. Let's say you had a buy signal to go long Amazon. Amazon was starting to take off, and so your strategy, whatever it is, gave you a buy signal right here. Most likely you would just jump in and say it's going higher, or maybe somebody recommended it and you want to get in. But remember, we want to use the confirmation technique. So we place a confirmation one tick above, and if it trades there tomorrow, then we'll buy, okay? Well, it didn't do that day, but our buy signal is still in effect, or let's say the guy that we follow, our trading guru, is telling us we still have to buy Amazon. Amazon is a great buy. It's a great buy. Unfortunately, it still hasn't traded one tick above the previous bar's high. But we continue to monitor it until ultimately, where is Amazon trading? It's trading below the 50 period. So we're not even going to consider purchasing Amazon anymore. Our trade is negated. So we saved ourselves a lot of money by never even getting into the trade. So this is another advantage of the confirmation method, because many times it won't even get you in because it never trades either one tick above or one tick below to go short. And by the time you wait, maybe the signal has negated or you're on the other side of the buy-sell line. So in this scenario, let's say some trading guru just loved Amazon and said it was going to go higher. Well, this technique saved you a lot of money, and you never even got into the trade. All right, so let's review here. Remember, the most important thing with the confirmation method is that you only want to listen to what the market you're trading is telling you. Your reason for entry shouldn't be because of some indicator or some trading guru or some news. We don't want to worry about those things. They're too filled with emotion. There was tons of news that came out today. The market went down, then it went back up, then it went down, then it went. Don't worry about those things. Just worry about what the market itself is telling you. And if we're using the confirmation method, whatever strategy you have, remember this is not, I repeat, it's not a strategy. It's simply a technique that you add on your strategy. Whatever strategy you have, if it issues a buy signal, buy above the previous bar's high, one tick above. And if it issues a sell signal, only go short once price trades one tick below the previous bar's low. As an extra added bonus, many times the confirmation method will keep you out of losers, okay, as we just saw with that Amazon example. All right, now I want to share with you I should say, we just shared with you the two most important edges that we have at specialist trading. That's the buy-sell line, and that's confirmation. But remember, and I can't stress this enough, these are not strategies. These are simply pieces of the puzzle that you actually have to add on to a strategy. Okay, so what we want to do is we want to add these onto a strategy so that we can lift our chances of being more profitable. Well, we'll show you right now one of our proprietary strategies that's usually just reserved for our members of specialist trading, and we're going to share with you the rules because you're attendees today, and we appreciate you taking time out of your Friday to come and listen to us speak. As I stated, my goal is to teach you. As you can see all the information I'm giving you, we always like to give you a lot of information that you can use for free, and then you can decide whether you want to become a member or not. So let's go over strategy number one of our most consistent strategies we have. And once again, I just want to reiterate, if you have a question, we'll be concluding roughly in about 10 or 15 minutes from now. So just simply wait till we get through the trading strategy number one scenario, and then you can ask any question you like. Okay, so just write it down or try to remember it. All right, so let's talk about some of the highlights of strategy number one. The best thing about this is that you can transfer it not only onto trading stocks, but also the E-mini futures and the Forex markets. In addition to this, it works in any time frame. So if you're an investor and you say, well, Steve, I only look at monthly charts, great. You can see signs of signals on monthly chart. If you're a day trader and you only trade 5-minute or tick charts, this can work just as well. Okay, so it trades both long and short. If you're day trading, you're going to get anywhere from 1 to 3 trades per day, depending on your time frame. If you're position trading, meaning that you're holding for overnight and you're looking at daily or weekly bars, you'll get about 2 trades per week. Okay, looking at the entire index, the S&P 500 index. Okay, so these are some of the highlights. Let's talk about now the indicators. These are the two indicators. Remember, we keep things as simple as possible. We're going to use our buy-sell line, which we use in virtually everything. That's the 50-period simple moving average. So you're always going to plot a 50-period simple moving average. And the other indicator are the 21-period Dodgy channels. Now, these are a very simple tool. You can find these on a lot of charting software packages. If your particular program doesn't have them, you may want to talk to your programmers and ask them if they have at your charting software, and ask them if they have them at the customer support. Many times they will have this indicator, and they'll simply ship it to you, or they'll attach it to you. You can put it onto your software. Many times as well, it won't be provided, so you can do a Google search, and you can find that there are a lot of free charts on the internet where they provide Dodgy channels. You can get them for free as well. Okay? If you have any more questions, you can email us and we can tell you exactly where to pick up those Dodgy channels. All right, so the Dodgy channels are our second indicator, and they're just simply three channels that we have. We have an upper, a midline, and a lower channel, and we'll show you some great examples. Now, you can write these rules down. These are the buy rules. I'll give you a second. I'm going to go over each and every one of these. Remember, this presentation is being recorded, so if you don't happen to write all of these down, or you scribble them and you don't understand your writing, don't worry. You can request through us through email, and we will send you a recording package of this. Rule number one, if we're going long, obviously price must be above the 50-period simple moving average. That's our buy-sell line rule. That's our first edge, which we explained to you at the beginning of this presentation. All right, rule number two, we're also going to plot the Dodgy channels, and we want to see that all three Dodgy channels are headed in the same upward direction. In other words, we can't have two going up and one going down, or vice versa. We have to see all three headed upwards. Okay? If we have these two things in place, this where it gets a little wordy, but don't worry, I'm going to explain to you on some charts, and it'll make a lot more sense once we go to some charts. But if we have the first two rules in place, rule number three, we're going to look to buy when a declining, okay, not a rising bar, but a declining price bar's range is entirely below and not touching the mid-Dodgy channel. So it's going to be selling off and be entirely below the midline, all right? This will be labeled our setup bar, okay? Now, rule number four is we start to apply the confirmation technique. We're going to buy one tick above the high of the setup bar. And every time we're going to continue to track, as long as all the rules are in place, we're going to continue to track and buy one tick above a high of the setup bar or new setup bars that are formed, as long as the buy signal is still in effect. Once price trades one tick above using our confirmation method, we're going to place our stop, our protective stop, below the lowest low of the pullback, the lowest low of that little sell-off we just experienced. And then where do we exit? Well, we'll exit when price touches the highest Dodgy channel. That's it. Okay, so we know where to enter using the confirmation. We're going to place our stop below the lowest low of that little sell-off. And then we're going to place our stop when price touches that top Dodgy line. That's it. See how simple this is. Let me show you how simple it is, but how powerful this strategy and how consistent this strategy can be. All right. Excuse me. Here's just a chart for educational purposes. Now, obviously, where is price in relation to the buy-sell line? Price is above. So that's our first rule. This means that since price is above, we're only going to be looking to go long. We're not even going to consider going short using strategy number one. All right. So now, this would be the most opportune place to buy, right? As we see here, we had a little sell-off. Looking back in hindsight, we kind of stopped right here, and then we headed back up. So how could we have taken advantage of that and purchased somewhere around this range here? Well, we add a little structure in the form of the Dodgy channels. This is the way the Dodgy channels look. You have the lower, the mid, and the upper channels. And as you can see here, even though they're not in sync, sometimes one will be headed sideways while another one is going stair-step. They're all going in the same direction. So even if you see a bar that is going sideways, you see that its previous direction was coming from a lower spot here. So that's still okay. It means it's coming from a lower setting. So even though this is going sideways, it's still in sync with heading higher, where others may be going a stair-step up, sideways, okay? So they're all three in sync, and that's what we want to see. All right, so we have those two rules in place. Now we want to see that this price bar starts to sell off. We want to see a little sell-off, or what we call a pullback. All right, so we see price starting to sell off. As it sells off, it touches the midline. You see this bar touch the midline, and this bar touch the midline. But we're looking for a bar that is completely below the rising midline, and that's right here, circled in blue. This is, as we stated, our setup bar. So we still haven't entered yet, but this is where we start applying the confirmation method. See, we didn't apply the confirmation method up here. We didn't start applying it until we got down to this level. So once price trades above, that's where we'll enter. Well, it didn't trade above in the next bar, but guess what? This is now our next confirmation, or I should say our next setup bar. So we just lower the price down here, and as you can see on the very next bar, we traded one tick above that bar, and that was our entry. So once we've entered, we protect ourselves because we're not going to say that they work 100% of the time, so it may be wrong. So we look to see that we had this sell-off here, and where was the low of the sell-off prior to entry? It was right here. So we place our stop somewhere below. It can be anywhere from 1 to 10 cents below. Some of our traders like to use 25 and even 50 cents lower to give themselves some room. Just as long as if you place your stop below the low of the little pullback or sell-off here. All right, so we've entered here, we place our stop here, and then we simply monitor and wait for stock to go up, and we exit when price touches the high line. That's it. That's how simple it is. All we're doing is waiting for the trend to resume and go back in our direction. Now these are the sell rules, okay? Now I'll leave them up for just a second. I'm not going to go over them. They're just basically the exact same things, but they're just turned upside down. We're just now going to be looking for price to be below the 50-period moving average. We want all three Dodgy channels headed lower. Now we're going to look to sell when a rising price bar is entirely above and not touching the midline. So this will be our setup bar. And our setup bar tells us where we start applying the confirmation method. So once we find a setup bar, we're going to go short when price trades one tick below the low of the setup bar. If we get short, we'll place our stop this time above the high of that little bounce in price, that little pullback to the upside. And then since we're short, we're going to cover or exit the trade this time when we touch the lowest Dodgy channel. All right, so let's look at an example of that now. Now price is below the 50-period or the buy-sell line. Even though we touch, remember, we're looking for the consecutive prices, and it's safe to say that the majority of all prices are below here. So we want to go short. We're not even going to consider buying whatever this happens to be. So the most opportune place, if you look back in hindsight, to go short would have been right here, right? This was the high of that little area where we bounced and then we went lower. So how could we have taken advantage? Well, we add our structure, which is the Dodgy channels. And as we can see, they're all headed in the same downward direction. Even though some are headed sideways, they're all coming from a higher point. All right? So once we've seen that, we want to see a little bounce now. We want to see price bounce and rally. As we bounce, we touch this midline and we intersect it, but we want to see a bar that's completely above and it's not touching the midline at all. That's this one right here. So this is our setup bar. This is where we start to apply the confirmation method, as we explained, edge number 2. So we're going to go short if we trade one tick below this setup bar, which we did on the very next bar. So this was our entry right here. Once we entered, we look where that little bounce was, and this was the high point of that bounce, so we place our stop anywhere. It's up to you, and we explain to you in our courses where to place your stop, how much room to give yourself for conservative or aggressive traders. So we've entered at this point, and we protected ourselves. Now we simply wait for price to either stop us out with a small loss or head in our direction, and once it touches this lower line here, that's where we exit. Now a lot of students will say, well, Steve, this is a great strategy. I love trading it, but many times it'll keep going lower or keep going higher after I exit. That's true. We're giving you just the standard basic generic rules. As a member, we teach you ways in which to stay in for the long run, as we saw right here, where you could have actually been in the trade and picked up an extra 5 or 10 points. This is for our advanced members, and this is when you become a member of Specialist Trading, we teach you all the tips and techniques, once again, that I've learned in my 36 years so that you can stay in the trade longer. All right, so we've gone over the rules, okay? Now you should understand the concept behind strategy number 1. Let's look at some examples real quickly. And these are examples that have happened within the last 3 or 4 months, some that have happened within the last week. And these were examples, once again, that our members were privy to that already know this trading strategy. This was in TSO. This was at the very beginning of January. As we see, we have all 3 Dodgy channels headed higher. Price is above the buy-sell line. And even though we intersected it, right here, these are our two setup bars, we would have entered above the buy-sell line, so it's perfectly admissible. So we saw here that price started to sell off, it touched or intersected the middle line, and then we had two bars here that were totally below. So once price traded above either one of these setup bars, we entered long at 41.48. Our members were told to enter long. We placed our stop just below the low of that sell-off, and then in about 2 or 3 weeks, price ultimately rose, touched the top Dodgy channel. We exited for nearly a 4-point gain at 45.44. Okay? See how simple that is? And this is a great example of confirmation. Once we entered, what happened? Price just headed in our direction. We hardly ever had a drawdown in our position. How about going short? Well, this was in Microsoft. This was at about 3 or 4 months ago. Going short, we were below the buy-sell line. We applied the Dodgy channels, and they're all headed lower. So we simply wait for price to rally. We wait for a little bounce in price. As it rises, it intersects the midline, but we're looking for a price that is completely above. So that's this, our first setup bar. Our second setup bar, we never traded below either of these. Our third setup bar, ultimately we traded below, so we got short at 29.53. We placed our stop at the very top of this little bounce, and then price headed in our direction. And we had a great cover here because price gapped to the downside on the opening. We covered at 27.02 on the opening, and we made nearly 2.5 points in just a week's time or so. Here's the letter R. This happened at the beginning of the year. This was, I should say, at the end of November, beginning of December. We had a textbook example of strategy number 1. Prices above the 50-period simple moving average. All 3 Dodgy channels are headed in the same stair-step upward direction. Price sells off. It intersects the midline, but then ultimately we have a setup bar whose bar is completely below the midline. So all the rules are in place, so we're going to purchase if we trade one tick above, which we did at 44.08. We placed our stop just below the low of this sell-off. And then look what happened. Textbook example. Once we entered, we had confirmation that we were going in our direction. We never went below our entry, and we exited just about a week or so later for nearly 4-point gain. Here was an example in Aetna. This was going back about a month ago in the middle of January. Same thing, we're above the buy-sell line. All 3 Dodgy channels are headed upwards. We would look for a sell-off. This wasn't as uniform, but we still had a sell-off in price, and then we had a bar that was completely below the midline. So this is our setup bar. We entered when price traded one tick above at 45.42. Now remember, we do not place our stop simply below the setup bar. It's below the low of that sell-off, which would have been right here. Okay, so a lot of students have a mistake. They'll place their low just below the setup bar. No, your low is below the sell-off low. And then once you entered, it took a little while to get going, a week or so, but ultimately you would have exited for a 1.63 point gain in just about a week or so. RHT, this was just a month or so ago going short. Now a lot of people would have said, boy, we missed this move to the downside. We're below the buy-sell line, and we missed it because we never were trading above the midline. But at the beginning of December, we had a little bounce in price. We traded above, so this is your entry point. Once we traded one tick below to go short at 49.25, we placed our stop above the high of that rally, and then in 3 days, you would have made nearly 2.5 points. See how simple that is. Once again, all this was done without the aid of any news. We weren't looking at any economic indicators or waiting for any forecasts or any type of earnings news, or we weren't even looking at more than one indicator, really. We're just simply following the Dodgy channels and listening to what the market was telling us. Okay? Now, I know a lot of you will say, well, Steve, once again, I don't trade daily bars. I intraday trade, or I trade hourly bars, or maybe I'm an investor. I only look at weekly bars or monthly bars. Okay. Here's a weekly bar of Costco, C-O-S-T. Now, going all the way back, excuse me, to the end of 2011, beginning of 2012, and on to currently, we've seen here that the price is pretty much above the buy-sell line, and we've had consecutive upward movement in the Dodgy channel on a weekly time frame. Every time we came off and sold here, we had these really nice entry points using the setup bars where you could have entered, exit once we touch the top. Here's another example later, entered, exit once we touch the top, sell off. We had entered here and sell off, and then we rally and then exit. Each trade here in the last 6 months would have made over 7 points. So roughly you would have had about 22-point gain, roughly being in these trades for just 2 or 3 weeks and just going with the flow, going with the trend. Once again, not worrying about what's going on in the news, not worrying what's going on, worldly economic conditions or what's happening in the world, simply listening to the market. Remember, I struggled for months, for years before my mentors taught me how the real road to being consistent in the market is by simply simplifying things, not by overcomplicating your trading. How about if you trade a 60-minute time frame? Well, here's the ETF of the Russell 2000 IWM. Okay, we have price below the buy-sell line, so you're only going to be going short on this hourly time frame, and these bars are all headed, these Dodgy Channels are headed lower. So price rallied, it intersected the midline, and then we have our first setup bar right here because it's completely above and not touching the midline. So we would have entered short at 91.09, placed our stop just above the high previous to entry, and then just simply waited. In about 5 hours, we made nearly 1.75 points. Or if you like to trade smaller time frame, here's a 10-minute chart of LinkedIn. As you see here, price is above the buy-sell line, so we're only going to be going long. We had some nice setups here where we entered, exited for over a point on a 10-minute chart. An hour later, we had another setup, entered, exited for another point. So roughly in about a couple of hours, you would have made a couple of points just simply going with the flow and linked on a 10-minute chart. All right, so let's recap here before we take any questions. What did we share with you today? Well, we shared with you our most important edge that we have at Specialist Trading, which is the buy-sell line. Remember, all it is the 50-period simple moving average. But in order to use it correctly, you have to plot it on every chart that you're looking at and ask yourself before you buy or sell. I don't care if you hear some news come out and you think it's great, or if some chat room tells you to go short or whatever. Look at the buy-sell line and ask yourself, where is price in relation to that? If some great economic news comes out, but it's below the buy-sell line, do not buy, because you're going against the flow, and the odds are it won't work out over time. If price is below, you should only be going short, and if price is above, you should only be looking for long signals. But remember, this is not a strategy, it's just a technique to get you on the right side. So simply because price crosses above the 50-period simple moving average, that's not a signal to enter. You have to look for some strategy that tells you, as we just shared with you right now, strategy number 1, that tells you where to enter. Okay? And then edge number 2, our confirmation technique. This is a great technique for fine-tuning your entries. Many times you lose money, traders lose money, not because they had the wrong decision, but because their entry was misplaced. You got in too early or too late. The confirmation method will help you fine-tune your entries so that you purchase either one tick above the previous bar's high or sell short one tick below the previous bar's low. And then lastly, we put these two together. Remember, they're not strategies. They're just pieces of the puzzle that must go with a strategy. So we showed you how we incorporate them in one of our most consistent strategies, strategy number 1. We gave you all the rules to that. Now, ask yourself, and I want you to ask yourself and be honest with you. I know you've attended other webinars, other educators, but ask yourself and be honest, would any one of the tools I've given you today help your trading this past year? Go back and look at your last series of 5, 10 trades, maybe your investments, and ask yourself if you had just applied 2 of these edges, or maybe if you'd been able to know the rules to strategy number 1 prior, could it have helped your trading? I always ask my students, and I always ask people that are considering becoming members of Specialist Trading, and undoubtedly, most of them always answer, yes, this would have been a tremendous help. The free information you gave us today would have just really elevated my trading to